Absolutely. One mistake that I commonly see is believing in the hype or following the sizzle of a stock. Oftentimes, small and mid-cap companies, especially in areas like technology, finance, biotechnology, will have a lot of excitement around them because of sexy products or interesting technologies. And people often crowd into these stocks and end up chasing them and drive their valuations sky high because they believe that they have revolutionary, disruptive technologies that could change the world. I think it's really important to stay disciplined and grounded and not follow the hype or the excitement. It's not enough to have sizzle. You really need to have some stake. And that means that the business fundamentally has got to be attractive. And that means the business has to meet a lot of these qualitative criteria that I mentioned. And on top of that, be reasonably valued as well. So I've oftentimes passed on companies that have really become momentum stocks in the business because I think that there's no longer the margin of safety. There's a disconnect between the valuation of the business and what I think is the stock price should be. So those are the kind of situations that I've tried to avoid. Another pitfall that I've come across, and maybe this will be an illustrative example, is management that is not shareholder friendly, especially with small and mid-cap stocks. Oftentimes the management is not as familiar with the street, especially if it's a new IPO business, and may not be thinking about shareholders' interest to the same extent that I would like to see. One semiconductor capital equipment company that I invested in met a lot of the criteria that we discussed. It was actually trading at around $12 a share and had nearly $7 per share in cash. So the business itself was very well capitalized, and on top of that, it met a lot of the qualitative criteria in terms of dominating the markets that it provided. The company name was Kulik and Sufin, and the company's ticker is KLIC. This business essentially dominates the bonding business. It's essentially the connection between the integrated circuit and the printed circuit board, whether it's wire bonding, wafer bonding, etc. And they have 70% plus of that market. And the problem that I discovered was that even though this business was doing well, generating a lot of cash, and generally, I would say, had good prospects going forward, there were some questions about product transition, etc. The management was not shareholder friendly. If this was a ripe case for an activist to step in, and probably still is, but they were not willing to pay a dividend. They were not willing to buy back shares. And on top of that, I saw that the CEO decided that he was going to essentially put all of his shares up for sale, granted for a 10b5-1 program, but that to me suggested a lack of confidence in the long term. I would have liked to see management buying shares when they were attractively valued, not selling shares. So that led me to exit the position.